Hello, I'm Graeme Bibby, Chief Investment Officer, joined by Matt Leong, Portfolio Manager. We're here to give you the outlook for the next quarter. It's April 2026. We've started the year pretty strong. We had good performance coming into the end of the year, and the outlook was good based on what we saw as the stimulus coming from a lot of fiscal spending from the US government and prospectively falling interest rates. So they were all positive. But we had a few little bumps along the way with a lot of AI news that were disrupting sector after sector, particularly software. So almost every week we had little sell-offs and then recoveries. We've seen a lot of liquidity coming into the year as well. That is money being pumped into the system. We see prospectively that banks will provide more credit into the system as well. Then we had the speed bump of the Iran war. That was interesting because although there was a wide range of outcomes, markets actually didn't react too much. We see that there was an inflation impulse coming through from that, and that preferably and hopefully not a permanent inflation tick up, but just more temporary. So we see the growth will settle down into still reasonably positive for the year, depending on the outcome of the war. So that's sort of on the overall macro outlook. Matt, what are we thinking about the equity side?
So we have stayed fairly neutral on equities. As you said, there's a wide range of outcomes that could happen in the war. Historically, wars have tended to have a short-term impact on markets and no longer lasting impact. However, this could be slightly different given that the Strait of Hormuz has about 20% of global energy trade passing through it, predominantly going to Asia, but it is very, very meaningful. So if there is a prolonged shutdown of the Strait of Hormuz as a choke point for global trade in energy, then we would see a bigger disruption to that and a worse outcome for markets. However, at this stage, that's still up in the air. We may or may not see this ceasefire hold, and that may be fairly positive for markets if it does hold. So for now, we're maintaining our neutral outlook. We have come into this period from a very, very strong position, as you've noted earlier, Graeme. And if we do get a quick resolution to this war, we can see those themes play out again and see strong growth. As you can see here in this chart, the blue line is earnings estimates. And on the far side here, we can see that has continued to tick higher regardless of the Iran war. If the Iran war does last for much longer than expected, that may deteriorate. So we are watching that pretty closely. And over in fixed income, Graeme, what are you seeing?
So coming into the year, we saw that inflation was reasonably under control. Australia was starting to heat up a little bit, hence the Reserve Bank proactively hiked rates a couple of times so far. And what we've then seen is the impact of the Iran war. So that had an impact on both interest rates, government interest rates and credit spreads. So government interest rates rose, anticipating an inflation impulse and possibly some longer term impacts there. And credit spreads gradually increased based on the longer and longer extension of the war. And that has since reversed. So we've seen still relatively higher interest rates as we expect central banks to not cut. In fact, there's more hiking or rising interest rates being priced in. We think they'll probably be pretty neutral, just being very cautious in this period. So interest rates elevated a little bit, but still reasonably steady, but credit spreads coming back down as we expect the business cycle to resume. So on the outlook, Matt?
I guess more broadly, since we've talked about equities and fixed income, more broadly coming into this year, we had increased our real assets exposure through global listed infrastructure in our model portfolios. That has played out very well with listed infrastructure offering both inflation hedging properties as well as benefiting from the boom in AI capex demand. Beyond global listed infrastructure, we also came into this year with a longer-term structural weakening of the US dollar. While the Iran war has basically supported the US dollar in the short term. We do still see that playing out over the medium term, assuming that the Iran war does get resolved fairly quickly. The other thing that we have introduced this year, in fact just a couple of weeks ago, is a thematic tilt towards semiconductors. We do believe that semiconductors continue to be very attractive from an investment perspective. There is still a structural demand growth story there from AI capex. What's more compelling for us in terms of timing is that prices have not kept up with earnings growth increases. So what we've actually seen for the semiconductor industry is that valuations have actually come down despite prices going up, and we actually see semiconductor valuations as much cheaper than they were a year or 2 years ago, despite giving good returns over that period as well. So we expect that to continue, and that's why we've turned that thematic tilt on.
So overall, you can see that the outlook has varied quite a lot since the start of the year. We've been proactive in some of the activity that we've done in managing our portfolios. We also see in the private markets there's a bit of noise coming through as well in the media, but we think that the reality underneath is actually more muted, particularly in areas like private credit. We still like the asset class. So there's a lot to do to be proactive in this environment as we see the business cycle continuing and likely recovering into the year end. Even if we have a declining environment, we'll see opportunities there as well. So there's investment strategies and things that we can do to pivot. If you have any questions about this, please contact your investment advisor and we'll see you next quarter. Thank you.